Hi, everyone. Welcome back to another episode of the Optimized Wealth Podcast. My name is Lance Norquest, investment advisor with Bellwether Wealth, joined by economist Alan Beaulieu. And today we're going to focus on the latest U.S. export data. Now, Alan, I know we saw a few things in the recent reports. No surprise we saw an increase of petroleum exports, but you called out one particular detail that had to do with non-monetary gold exports, which we both found very interesting. So I don't know if you just want to start off by maybe defining what is non-monetary gold, and what is the data that you saw within the exports data recently?
Yeah, I'd be happy to, Lance. You're right. It did caught my eye is because it's new. I mean, exporting gold it goes on, but non-monetary gold first. You asked for the definition, and that's the way to start. It's gold that's not used in a transaction, financial transaction. So some non-monetary gold is used in industry, jewelry, consumer chips, semiconductors, that sort of thing. But the bulk of it is used for investment. People who want to hold gold as a protection into an unknown future, or because they think their other assets are going to decline in value and gold's going to go up in value, so they want to gain the value increase.
Mhm.
Which you have to be willing to sell it. That's the important part, and a lot of people aren't. Once they get gold, they become like Gollum in Lord of the Rings. Gold.
My precious.
That's right. Exactly right. So that's all that it is. But in 24, like I said, second quarter started to say really started to go up, but the first quarter of 25 it shot up. Tariffs started getting people wanting gold, and then in this year with the uncertainties that have come about, we'll just leave it vague like that. People have really wanted gold. Then we get to the war, 10 weeks of the war. And in February, the war was on, started, and just really shot up to record high numbers in February. There'd been no February in history like the amount of, not even close. I mean, it was
Hmm.
just in January, we had record high exports. The export side that was goods was driven by non-monetary gold, which is not common. In February, another record high for exports. Of the increase from the month before, 69.6% was the increase in non-monetary gold. That fantastic February I was talking about. And non-monetary gold was a big number in March, but it was superseded by what you said, oil, because of all the problems in Iran. We were exporting oil to like there's no tomorrow, and natural gas and other petroleum
Mhm.
products. But the fact that the uncertainty that I don't know if I'll get in trouble for saying this, that the U.S. more or less created in the world with Greenland and tariffs and all the rest of that. Major players, China is one among other major players, have been, in India, which you mentioned, and others have been wanting gold. And I'm not going to say hedge because you know that term better than I do, as a protection, a political and economic uncertainty, there's a comfort in holding gold. In Texas, they add in bourbon and bullets to gold. But so what are you seeing along those lines, and how do you feel about holding gold? I mean, you're the investment advisor, so I'm going to be quiet. Now that we know that there's just a great demand. Is it a good idea?
Yeah, no, again, it was an interesting piece that we saw in the recent data. And just from reading, China has been adding to its gold reserves for the last 16 straight months. And prior to us, starting to record the podcast here, Alan, we were even talking about India. As I'd mentioned, there was an article in the Wall Street Journal that was posted today, which is May the 13th. Has increased their tariff on imported gold from 6 to 15%. And India is one of the largest consumers of gold, largely because there's some cultural significance to it. But it's also it's a prized investment asset, which is, that's a global thing. We have that even in the United States, as you mentioned. People buy it and people like to hold on to it. Um, so, what are we seeing? Why are people buying up so much gold right now? And I think you kind of alluded to it. Gold really spikes when we see uncertainty. We saw it kind of last year with the discussion around tariffs. There was these geopolitical uncertainties. There was the expectation of higher inflation to come, and there was some weakness expectations in fiat currencies as well. So US dollar, for example. So people
Yep.
are wanting to buy something that's a finite resource that is also, which can be tangible in nature too. You actually can hold gold and you hold that value, whereas, the US dollar, with it being a fiat currency, it's backed by the full taxing authority of the United States government, which is something you can't really hold outside of the paper it's printed on, if you will.
Yeah.
Um, so where do we see gold? I see gold as a great diversifier from an asset class standpoint. We have it in client portfolios today. Again, it's a great hedge when it comes to a lot of the uncertainties. This year has really been plagued, if you will, with uncertainties. The Iranian conflict, we heard it was going to be, a couple weeks, and now we're multiple months into it. The ceasefire is on the brink of, falling apart, and there's no real end in sight right now. So again, uncertainty. We continue to hear about the Magnificent Seven or these big tech names, these mega cap stocks that continue to do well, but at some point, are they going to have a pullback? So
Mm.
there's still uncertainty. And then, just we talked about it in previous podcasts where US stock market, historically speaking, it is overvalued when you start to look at like Shiller ratios or price. Not to say that it isn't still a growth opportunity or an investment opportunity, but there are signs of other opportunities elsewhere, and we're seeing that with gold. So I think it's important to make sure that it's not a concentration in your portfolio, but it definitely can play a part. And there's several ways you can add gold to your portfolio. The way that we work with our clients and making sure that they get gold is through the form of an exchange traded fund or an ETF. And the reason we like that is because it's very, very liquid. It trades just like a stock on the market exchanges. You can buy it today and you can sell it tomorrow. So you get the diversification of the asset class itself, but you also get a tremendous amount of liquidity that comes with holding it as an ETF. I know there's something to be said about buying physical gold too. You can virtually buy it physically and take possession of it and have it in your home or in a safe or bank safe deposit box. There's other forms of buying gold inside of your investment account. You can buy physical gold, like gold IRAs right now are very popular, where you buy the gold inside of your IRA and then it's custodied or held by this other broker in their vault. So there's other forms and ways to invest in it, but that you start to dial into, or you start to get into an illiquidity factor. It's not to say you can't sell the gold, but it's not like you can just sell it tomorrow and get access to whatever the value is as of that time in US dollars. You'd have to go work with a bullion broker, or you'd have to go to a pawn shop or work with this actual broker that's managing the gold IRA itself. And you'd have to work through some of that. That's not to say that it's not an opportunity, or I mean, there's clients where it makes sense for that, but we find that the liquidity piece of it is very important for managing funds.
That makes a lot of sense to me. And there have been times in history where gold, you're not allowed to trade in gold. You're not allowed to use it as a currency. It's an underground kind of currency in really troubled times when governments are
There have
worried
been.
about. Yeah, so there's a risk there. And the other one I would point out from time to time to people is, well, if you really want to keep it in your house, fine, just write down your address for me because it could be
Yeah.
stolen.
Again, I know that I know individuals, we have clients that have physical gold and they've done well with it I mean, gold was up 50% last year alone. So,
Yeah.
and silver is not too far from, it was doing well as well. But yeah, I agree. There's a safety piece to it, and then there's also the liquidity piece. If you went and walked into your nearest pawn shop tomorrow and tried to sell your 1 ounce American Eagle gold coins, or your bullion, you're not getting spot price. You're going
Right.
to get some type of a discounted price, which again, it's probably grown to a significant value over what you paid. But you know, that's why we like to use the funds themselves inside of portfolios. Something else I thought was very interesting with gold exports is uh, there's an arbitrage opportunity that we see sometimes with the import and exporting of gold, where the owners of this actual gold themselves, so think like maybe a large bullion broker, they may currently hold their gold in London on the London Exchange, but if the demand and pricing in the US markets is higher, it can create an arbitrage opportunity where it's worth shipping it overseas to the US and then pledging it. And then they sometimes have to even recast it because there's different
Hmm.
specifications depending on the market and the exchange itself. But then they are able to capture the spread, which is very interesting from an institutional standpoint. So it's more than just your average retail investor or some of these larger countries like China and India, for example. They're making, stockpiling gold and making some of these movements.
It is interesting. Uh, I guess like in most things, there's these really big players who can move and create amazing wealth and actually somewhat move the market and at least lead the market in valuations and ideas. Well, the rest of us just try to. I like the ETFs that you provide because it's simple and it's in and out. It's got the liquidity and it's hassle and worry free, in my opinion. And but these big guys doing what you just said, they must make a fortune and a half by doing that. I mean, that's got to be.
Yeah, I mean, there's obviously costs associated to shipping it overseas, and then having it recasted in certain instances. But again, if the gap between the pricing and the arbitrage itself is that advantageous, you're absolutely right. That's an easy way to make a quick buck by simply just shipping it elsewhere.
Yeah, amazing. All right, so my recap is that the export numbers look better than they actually were because of the non-monetary gold in January and February and the overwhelming demand for oil in March. So I didn't get real excited about the numbers, but I did get excited about the gold. I thought that was fun.
Yeah, I think my key takeaways would be you kind of hinted at it earlier. It's the non-monetary gold exports. It's less about the jewelry that people are buying. It's not necessarily there's a high demand for necklaces now. It's more about global anxiety. And so, it's the inflation concerns, geopolitics, weaknesses and potential in those fiat currencies. So uh, and then they arbitrage opportunities, as we just mentioned. So again, we see an opportunity for having gold and other precious metals inside of your portfolio. It's just important to make sure that it's dialed into whatever your risk tolerances are and your objectives are with your portfolio itself.
Absolutely. But you wouldn't say no to somebody. You just say, let's talk about
Let's talk.
it. Excellent. Well, thanks, Lance. It's been fun.
Yeah, another great topic. And that's all for today's episode. So, for our listeners, thank you again for joining. I'm Lance Norquest with Alan Beaulieu, and we'll see you next time on the Optimize Wealth Podcast.